All right, let's jump right into this explainer and decode the financial DNA of India's absolute market titans. If you've ever found yourself wondering exactly how these massive giants of the Indian stock market maintain their dominance year after year, well, you are in the perfect place. We're going to break down the actual mechanics of the Nifty 50 and see exactly how a company's qualitative strengths translate directly into hard quantitative gains. Here is our roadmap for today. We'll start with the Nifty 50 engine, then move into finding the competitive moat, spotlighting the brand moat, key profitability metrics, valuation and growth, and finally, building your strategy. So let's get into part one, the Nifty 50 engine. We are going to start at the macro level here, looking at the literal engine driving the Indian stock market. You see, the Nifty 50 doesn't just lump all 50 companies together and treat them equally. Instead, it weights them dynamically using something called free float market cap. Basically, it only cares about the shares that are actually available for the public to trade, completely ignoring closely held promoter shares. This is super important because it captures about 66% of the National Stock Exchange's entire float-adjusted market capitalization. It gives us a real, unfiltered look at true market liquidity and value. And honestly, this paints a pretty wild picture of market concentration. Seriously, just the top 10 heavyweights in the index can account for up to 60% of its entire movement. When those 10 giants decide to move in one direction, they drag the whole Nifty 50 with them, even if the other 40 companies are just sitting completely flat. Moving right along to Section 2, finding the competitive moat. So, what actually gives these massive corporations the power to hold on to those top spots and stay wildly profitable, even when the broader market gets turbulent? It all comes down to their defenses. If you think of a thriving, successful business as a literal castle, the competitive moat is that deep, strategic trench keeping the invading competitors out. It's not just about selling a great product today. It's about having structural, built-in advantages that guarantee you're still going to be the market leader 10 years down the line. Now look at the very distinct ways these Indian blue chips build their defenses. You've got regulatory barriers like RBI licenses protecting the big banks. You have huge switching costs that effectively lock in clients for the big IT service providers. You have massive cost advantages held by resource giants like Coal India. And of course, powerful network effects. But let's be real, the first one on that list, the brand moat, is definitely the most visible to us as everyday consumers. Which brings us to Section 3, spotlighting the brand moat. Let's zoom in on that brand moat because it's arguably the easiest defense mechanism for retail investors to spot. Take a look at companies like Asian Paints, Hindustan Unilever, or Nestle. Over the decades, they have built up such insane brand trust that they command the ultimate premium pricing power. Competitors literally can't just swoop in and offer a cheaper alternative because the consumer is actively hunting down that specific trusted brand name. Once a moat like that is established in the Indian market, it is incredibly difficult to breach. And thanks to that unshakable consumer loyalty, Asian Paints carries a seriously heavy weight in the Nifty 50 index, consistently sitting between 1.03 and 1.09%. It's genuinely awe-inspiring when you think about it. Consumer preference for one single brand dictating such a massive market presence. You can see the sheer power reflected right in its stock price action too, charting a 52-week high of 2,986 rupees and a low of 2,116 rupees. It's just a massive, stable driver of the broader Indian economy. All right, let's hit Section 4, key profitability metrics. So here is the million-dollar question. How does an abstract qualitative concept like a brand moat actually translate into hard financial data? To see the real scorecard, we have to look at efficiency metrics like return on capital employed, or ROCE. This metric basically proves whether or not management is actually squeezing the most out of their resources. Taking Asian Paints as our focus company, their efficiency is just phenomenal. Over a 5-year period, they've posted a steady sales growth of 10.38%, alongside a profit growth of 7.37%. And here's the best part. Because of their brand mode, they don't have to constantly burn huge piles of capital just to stay relevant. That efficiency translates into a highly impressive return on equity hovering between 20.59% and 21.80%, and an outstanding ROCE of 25.72%. Just to show you how this stacks up across the market, check out how asset-light, brand-heavy moats like Nestle and Asian Paints compare to a highly capital-intensive business like JSW Steel. Look at Nestle. They're operating at a staggering 95.66% ROCE. It just proves the point. When you own a premium brand, your ability to generate pure profit from the money you invest back into the business is on another level completely. On to Section 5, Valuation and Growth. Now, you might be thinking, great, the company prints money. But just because a company is highly profitable doesn't automatically mean its stock is a bargain. We have to talk about valuation. This is where we figure out what the market is actually demanding we pay for these premium castles. The P/E ratio is our thermometer here. It tells us the exact premium investors are willing to shell out today for a company's current earnings and its anticipated future growth. A high P/E, that means sky-high expectations. Sticking with our Asian Paints case study, its P/E ratio typically bounces between 57.92 and 59.72. Now, on paper, that is a pretty steep number, but it tells us a compelling story. It shows that investors are totally fine paying a massive premium for the sheer safety of that brand moat and those steady 5-year growth metrics we just looked at. Basically, they're paying top dollar for certainty. And this is where data storytelling gets super interesting. Contrast the bargain basement pricing of Coal India, just chilling at a grounded PE of 9.06, with the absolute astronomical market confidence baked into an e-commerce platform like Eternal at a PE of over 1,055. I mean, wow. One signals a classic hunt for undervalued resources, while the other screams intense, unadulterated speculation on future hypergrowth. Finally, let's wrap up with Section 6, Building Your Strategy. So, how do you actually apply this entire blueprint of moats and metrics to your own personal investing framework? Well, your strategy inside the Nifty 50 should entirely depend on your risk profile. You might be a growth-oriented investor, aggressively hunting for premium market leaders with high ROE, totally fine with those higher PE ratios because you prioritize management efficiency. Or, on the flip side, you might be a conservative investor, looking for the safety net of undervalued, income-generating giants with low price-to-book ratios. If you're in that conservative camp, those robust, resource-heavy moats of state-owned entities like Coal India and ONGC are incredibly attractive. I mean, ONGC actually trades below its book value right now at 0.97. But the real kicker is the steady dividend yields. Coal India hands out a 6.04% yield that beautifully cushions any long-term capital gains. It's a completely different, yet incredibly lucrative way to play the market. So as you dig through the Nifty 50 and start building out your own strategy, keeping all these metrics and moats in mind, I want you to ask yourself this one final question. Are you paying a steep premium for future growth in an impenetrable castle, or are you quietly buying up hidden value in an undervalued fortress? The numbers are all right there on the screen. How you read them, well, that's entirely up to you.